and we're going to spend the next 45 minutes or so talking about a bunch of different aspects from reinsurance programs, from what does it look like, when to get started, and just kind of hopefully learning from what we kind of talked about earlier is that not all reinsurance programs are the same. They're not kind of treated equally, and they shouldn't be, right? Everybody has different operations, different goals, similar problems, different car prices, things like that. So the goal today will be to kind of dive in and answer some, or ask rather, some teed up questions for us to kind of get it going here for the panel, and then hopefully allow you guys some time here at the end to ask questions about how you might apply it to your business and what changes you might be able to make, or what things you think you're doing better than the rest of us, which is also has a lot of value. So thanks to Mr. Luke and Jeff and Mr. Brill here. We've known each other for how long now?
Jeez.
20-ish years?
20 years, yeah.
20-ish years. My very first 20 group was with him in Torrey Pines, California, a long, long time ago. And when we first went to my first outside 20 group meeting, I walked in there feeling really confident and really excited to share with the group just how amazing my father and I really were. and we were there for about 45 minutes into our first meeting, and this is back when we still had the big books, and we're going through the books, and I remember my father leaning over and saying, "So what do you think?" I said, "I think we should just keep our mouth shut." Because we were by,
You kept your mouth shut?
Back then.
Oh, okay.
Back then.
Wow.
And it was really an experience to see so many people approaching the business so many different ways, and that group really did have a lot of characters in it, and different personalities and very different ways of doing things. So hopefully we can get that same type of experience here. And obviously everybody here in Santa, has a reinsurance company already. You're using it in some way to, obviously generate revenue for yourself, protect your portfolios, things like that. The first question is, when did you get started, and when do you think a person should be thinking about starting that reinsurance company?
So we got started with reinsurance. So we opened our business in '85, and I took over in '01. And I think in about '05, I said, or '05 or '06, I said, man, we're giving these warranties away to people. We're not telling people. We're selling everything as is, and I should really start my own warranty company. And I knew nothing about reinsurance, so I invested about 5 years of trying to figure out how to start my own warranty company in the state of South Carolina. And I got to the point of figuring out I had to have some crazy amount of insurance waiver, or not insurance, but an insurance, and then I had to do this, and I said, there's got to be a better way, and I went to a convention or something, and somebody started talking about reinsurance. So I said, what is that? And next thing I know, in 2011, we started our reinsurance company. So we're almost 15 years into our reinsurance company.
Very cool. Jeff?
So my reinsurance company, I went for a long, long time just with the attitude that I couldn't put away the cash, that it was a cash flow issue, and I was so scared of hurting cash flow by having to siphon money off to my reinsurance company. So I've only really been full speed into my reinsurance company for maybe 3 years, started with another group and moved over. And my CPI, I'm only 10 months into that, fully in CPI. So I'm kind of the example of a newcomer to the CPI program.
Okay. Brill?
So I'm thinking about the question about how I got started. I'd have to say it was primarily from coming to conferences, because when you're first in business, as we all know, when you first start, you don't know what you're doing, but if you dedicate yourself to educating, getting better, coming to conferences like this, and of course the ones I went to, I learned about reinsurance, and then we've always had a lower ACV vehicle, which requires a lot of service infrastructure and a lot of warranty repair. We also know that the car breaks, the customer doesn't pay, so we got to learn that real quick. And that's how we got introduced to reinsurance. And initially it was difficult cash flow wise, but and at our height, we were on reinsurance on steroids in about 2018.
That's usually how those progress. It's always the same thing. I heard about it. I knew I should probably do it. Maybe I knew somebody who was doing it. 3 or 4 years down the road, I finally started doing it, and people will limp in with, one product or one thing, and then once they start to kind of see how it works and the money going, and is that cash flow constraint that they originally thought as bad as they thought it was, and then that turns into a couple years down the road where now that person is trying to maximize every possible opportunity for the reinsurance company. What more can I do? And then the two questions are always the same. It's, man, our two topics. It's, I wish I would have started this 5 years ago, and now that I have this reinsurance company and I have this premium in there, it's always like, well, now what? Like, what do I do with it next?
I knew, before I knew about reinsurance, I knew that's what I wanted to do. And I was probably one of the first dealers I knew that did it, right? And the cash flow thing is so important, because it gets scary, right?
Yep.
And I remember, 2 years into this thing, and we started with a 3 months, 3,000. And then it quickly evolved into more, 12, right? And then drive time shows up in our town. And back in the day, drive time was giving every car 336. And so I just thought that I had to compete with drive time. And so all of a sudden we slapped 3 years, 36 on it. And the cash flow got tight. Mm-hmm. I mean, it got tight quick. And I remember talking to Dave Keller one day, and I was like, Dave, I think I'm stopping my reinsurance company. And Dave goes, you really want to do that? I was like, man, we can't afford this. And he said, let's hop on a spreadsheet real quick. Mm-hmm. So he built a spreadsheet and all of a sudden showed me the difference in the taxes, right, with and without. And he goes, you can't afford not to have this reinsurance company. Even if it hurts you cash flow, it's saving you so much in taxes, you got to keep doing it. Mm-hmm. I said, oh, okay. But you don't think about that.
And I think the other thing when somebody's first getting started is you look at reinsurance like all of these things are additional expenses. And then you realize it's not. It's expense and risk you already had, but you called it policy. And then you turned it into a warranty, right? You had a whole employee or extra employees managing all of your insurance claims and your losses and acting like collectors for Geico to send money to someplace else. And then you realize when you have your CPI program, you bring that in-house, and the manpower and all the effort. It's all things you were already doing. You were just either misplacing the effort or you were spending the money in a different way and calling it something else. But then you get no benefit for that, right? Because I remember when it was as is, and everything was as is. And then we all started doing warranties, and I think it's because people realized your customer doesn't call you when a check engine light comes on, right? They put a picture of their kid in front of it. Mm-hmm. They call you when the car breaks down. Warranty programs became something was like, okay, well, if I'm already going to do it, if I'm already fixing the cars, and if I don't fix the car, what happens? I repo it, and the first thing I do is fix the thing I told the person I wasn't going to fix. So I was already spending the money, but I was getting nothing for it. And the customers don't appreciate it, right? So that program in black and white helps us to account for those future losses. It's not just money going out in addition, right? It's a better way to account for a transaction I already have. And was that kind of similar to what you guys realized, that it wasn't quite the cash flow problem you thought it was going to be?
Well, I can just summarize it for myself. I know I often state this with sincerity that the 3 best decisions I ever made in business was getting into Buy or Pay was number 1. Number 2 was getting in a 20 group. And then the third thing was reinsurance. And I'm sure we're going to delve into reinsurance more extensively after we talk about how we got in and things like that. But it's been an enormous game changer for not only our business and our performance, but my family.
Absolutely. And yeah, diving into reinsurance, I think probably the most popular topic as of late with all of the things going on in the world and rising costs is definitely the insurance conversation. CPI, damage waivers, debt cancellation, all those different things. So what products are you currently, or what are you doing currently with your reinsurance company to handle those insurance risks, and how's it working out for you?
For me, what we do is we do CPI. I keep it very simple. Like I said, I'm new to it. I'm smaller, so I am getting my feet wet. And I did the same thing with my reinsurance. My service contracts that I would sell and my warranties that I would give. Is I started small because it is tough, and I look at it. more of a forced savings account, right? It's forcing me to put aside a premium every single month into my reinsurance company. And the first company I used wasn't really great at painting the picture of when I could get that money back to me, So I kind of looked at it like it was just money that I might someday get access to. Obviously, being with Buckeye now, it's much more of a picture of, hey, let's get this to the point where we can lend this back to you if there's a cash flow issue, or if you have higher debt that you need to pay off. You've now forced yourself to save this money. Let's bring it back in. So that's the way I looked at it in the beginning, and I started very small. And so same with my CPI program. I don't have all the products. I don't offer everything. I'm still giving away gap. I don't even reinsure for it, so we're going to have that conversation later. But with my CPI program, I love it because it's found money. And I think that's the big difference between all those reinsurance products, right? I can tack on everything to the contract and try to finance it, and I'm never going to collect it, or I'll collect 75 cents on the dollar, basically. But with that CPI, man, that's a game changer, right? Because that's just found money.
It took Jason years to convince me of CPI. I figured I have a higher ACV. My ACV's around 13 grand, and it took years for me to think about it. And honestly, we had such great full coverage in our portfolio and we had anywhere from 10 to 15 totals a month in general, and we were getting all that money from Geico. But something you just said a minute ago about we were actually collectors for Geico. We weren't, because we would turn the car off or do this, that, and other to make sure they had full coverage all the time. And finally, about 2 years ago, I said, all right, Jason, let's go. Let's do it. And so our goal the entire time is to get to 40% of my portfolio in the CPI. And it's been a slow roll. And we finally got the buy-in about a year ago.
From the staff?
From staff.
Yep.
And it was a conscious switch. And another thing that helped it, insurance coverage in South Carolina, insurance rates have gone up about 40% in the last 3 years, because the cost to repair a car is getting so much more expensive, especially with COVID, 3-week backlog at most body shops in South Carolina. And so it really helped us put all our effort into CPI. Now, we're not at that 40% goal yet, but we're at 25%. And starting with 0 penetration to 25% in under 2 years, I think we're doing pretty good. And we're actually, it's a snowball. It's a flywheel, if we want to stay on the good to great metaphor this week, that once you get that flywheel moving, it just continues to spin. And when we first thought about 40% of coverage, and I figured 40% coverage would end up netting us, 30 grand a month or so net, which is a lot of extra money, right? That I can see this thing going to 60 and 70% if we continue down the path we're on.
Yep, and you're not doing CPI or
No,
mandatory right now,
so
right?
we're in the Philadelphia market, so for the last 34 years we've been in business. It's always been a high insurance market, and we've been fortunate to have high penetration on debt cancellation, and to stay in compliance, because we're always concerned about compliance with our high penetration rate. But it was clearly the choice by the consumer. We still do it today. We get the quotes right online for their coverage, and we present them, and then we present the debt cancellation quote, and it's an easy decision for them. So that's what drove it, the market that we're in. And then so the debt cancellation just became, we were in 70, 80% penetration, which many people were saying, well, you gotta be careful with that, how you can defend it. But we felt comfortable we were, and you're right. I mean, you think about it, you go into a casino and you see the opulence of the casino and you say, who's winning here? Well, you go in, you see insurance buildings and you see the affluence they have. You say, who's winning here? So obviously that's why it's so lucrative, potentially, once you get to that point where you're cash flowing.
Yeah, when you're starting these programs, a couple of things to think about too is, in this business we have all types of, confirmation bias, things that we know because we've all told each other this won't work because, and then we find out different. A perfect example of that is car prices, right? I remember being in this business and ACVs were $2,500, and if it ever got to $3,500, we were all going to be out of business.
Yeah.
And if we ever went over 24 months, we were all going to be out of business. And then it was $4,000, and then it was $5,000, and magically, we're all still here. And with CPI or debt cancellation or something else, I think the initial knee jerk is, man, we're already asking these customers to pay us so much. How are we going to collect even more? And then you realize through training your staff and everything else is that we're not asking them for more. We're replacing a large insurance bill that comes at a bad time in the month for their budget with a much smaller one that we set up according to how they get paid or that they can collect in one spot, right? So it's not more money, like we're replacing it. And it's the exact same methodology we used for ourselves, right? It's not more expense we're creating ourselves, it's a reallocation. So I think that's important. But whether you're doing CPI or a damage waiver or debt cancellation, things that come into consideration, what's my market like? What are my ACVs, right? Debt cancellation with $13,000 cars, probably not the best idea. If you're super rural versus being in a metropolitan area, all of those things are going to come into play with why you should choose what you choose. So I'm curious, when you had the option between, other products, debt cancellation or CPI or damage waiver, because whichever one you pick, it's an organizational commitment, right? We talked about this earlier. You don't use these programs as, oh, well, this will help me sell cars to just the people who can't get insurance, right? And why don't you want to do that?
You just get negative feedback loop there.
You're going to get crushed because you're creating a pool of risk with your most risk people, right? So when you start one of these programs, you just kind of go all in with it. But with all the different things and options, obviously, all buy here, pay here, buy here, pay here, and then buy here, pay here. Your lease here, pay here now, right?
Just recently.
Just recently. So everybody up here is, damage waivers other than, Brill isn't really an option, right? Because that's just a lease-specific thing. So since we're at the LHPH Summit, we should probably talk about damage waivers a little bit. Do you guys understand or know what's the most major difference between the CPI and the damage waiver programs?
No, I really haven't revisited CPI because,
Yeah. So the biggest thing is CPI is actual insurance, right? There's an insurance company, there's an actual carrier, somebody behind it. It's Great America, Ohio Indemnity, Fortegra. There's a real insurance company, there's a real policy. Damage waivers is more of like a self-insured program, right? Very parallel, they kind of do the same thing. A lease here, pay here, dealer could do either one. It just depends, again, lots of questions that you could ask. Biggest things that come into place is, and it's just like the differences between debt cancellation and CPI. If you had 100% debt can penetration and somebody came knocking,
yeah, that'd be a problem.
it'd be a problem, right? If you had 100% CPI penetration and somebody asked, no issues, right? Because insurance are absolutely allowed to force people to have it. Damage waiver is an optional type thing, right? So there's some issues there. Same thing comes into place with midterm placement. Because like debt cancellation, it's kind of has to be sold at the point of sale, right? So if you had a customer, for example, who chose to get their own insurance, and then a year from now they cancel it, right? What's your process? What's your option there?
We give an option to bring in the insurance or have the debt cancellation placed
Right.
on it.
So you can place it, and then they come into the store, sign some forms, something like that.
Correct.
Yep. Same thing, same process would be true for the damage waiver. With the CPI program, because it's insurance, the customer doesn't have to come in. You can do what's called forced place. We like to call it midterm place because it just sounds nicer. But again, so there's just some different options there. And how are you guys, how much would you say of your penetration is, because I'm curious what your penetration rates are, is point of sale versus that midterm?
We aren't good at point of sale yet. And I say yet because, we're still learning. Our typical customer has always had full coverage insurance. If you look at our portfolio, there's some, high 500 credit scores, people who have really good jobs, and so they're used to having full coverage insurance. The problem they have is that full coverage insurance lapsing. And so most of ours are midterm placement, as we'll call it, or forced placed. The ones we are getting at point of sale are the ones you don't want. And so we've seen, and I think that's part of the starting process, the speed bumps that you have when starting a CPI program. At first, you're going to negative select, and so you're going to get the worst customers first, and you start to feel some pain, and then your portfolio, once your insurance agent in-house gets good at explaining the product to customers, you'll get more and more. And so we're probably 80% midterm placed compared to point of sale, and we need to get that point of sale. I'd like to see us be 50-50, but we won't hit our goal of 40% until we are 50-50.
Yeah, I mean, it comes down to a sales process issue at the beginning. I mean, you're getting 70% penetration, so thinking about the products that you have besides debt cancellation, like how does having a reinsurance company and having your own products, and two parts, what are you doing and how does it impact the dealership operationally?
Well, the service contract, a warranty essentially, we just included in the price. So when we were at our peak, we were at 30, we were 30-30. Now we're 18-18. But I mean, it was crucial that we're going to be paying for the repair anyway. Our vehicles break more frequently because they're older and have higher mileage, so we knew that. And as I mentioned, we had to have the service infrastructure to make sure we could handle the volume. But it was just it was a logical decision when you're talking about money in, money out, and be able to keep the money in the reinsurance company. And ultimately, when it turns out, it's your money. And furthermore, I'll tell you that the reinsurance company ultimately led to us being able to purchase multiple real estate properties and various other investments we made because of the reinsurance company that we wouldn't have had.
Can I ask, with your back-end penetration on that product, is there someone incentivized on that? Is that why that's so high?
You can't do that.
You can't because it's an insurance product.
Right. Well, no,
your guy doesn't
we're
get a
just doing that
percentage of
because
back-end.
we've just been always so focused on compliance that we've just created a culture where we're presenting to the customers a win-win, and it's not a sleight of hand. We show them we clearly show them the estimates from the other insurance companies in the area and their own insurance company, and it's a pretty easy decision for them to choose ours because we're always less. So, and then furthermore, because of our penetration, we don't have as many of this midterm interruption thing. And frankly, even when we have that, we look at the collateral, we look how long they've been on the books. We're not going to start forcing place debt cancellation on them when the car's probably worth $1,000.
When it comes to warranty, we give warranty as well, 12/12, but we also have a process of selling 24s and 36 vehicle service contracts. We also reinsure our gap. That might be one of those things that, does that even come into effect in lease here, pay here? I'm sure it does.
For sure, yeah.
Okay. But the sales process is so important. Our gap penetration is 70%. We upsell from our standard 12/12 to 24/36 55% of the time. And it's all about the sales process. And we make people decide right then, what are you going to do? But the difference that has made in our reinsurance company is amazing. To go from, it being a cost center that we're spending $800 every time to our reinsurance company. Now people are buying extra. Now we're discounting that so they can get extra coverage, but we all know if the car's not running, they're not paying anyway. So we tell people that. We show people instances. And the VSC being inside of our reinsurance company it's created so much extra revenue for our reinsurance company. It's amazing.
Bret, can I ask you, what are you seeing the best dealers doing to get the penetration like that on products? Whether it's vehicle service contracts or whether it's my CPI, because that's what I struggle with, right? Can I incentivize my salesman or the person that I have in charge of my CPI program the way you might incentivize a sales manager to upsell a warranty? Are you seeing it as they're giving incentives and that's getting good success, or is it just ingrained in their sales process and they just know they do it that way every single time?
Yeah, so I think it's important that they know, like, not to sell these products at the point of sale, right, that they're offered. You definitely don't want to incentivize salespeople. Plus, as an owner myself, like, incentivizing my salesperson to do what I need them to do, like, that's frustrating. Because this helps, right? So when we're trying to explain to the sales staff, rather than just saying, hey, this is this thing we're doing now, right? Because maybe you've got a good relationship with an insurance broker, right? And they like it when the pretty girl brings the candy in and hands them their $25 gift cards and stuff like that. So you're taking that away. But what you're going to be doing is you got to start talking to them about, like, hey, how many sales did we lose last month because they couldn't afford insurance? Who likes trying to get a hold of an insurance guy at 6 o'clock on a Saturday when we're selling a car, because of a customer? You know what I mean? And then same thing with your collectors and with your portfolio, right? Everybody in here would love to sell 3 more cars a month or add 3 more cars to their portfolio. What if we didn't have to spend more advertising dollars? What if we didn't have to sell more cars? What if we had to repo less, right? So when you talk about the impact of reinsurance companies on your business, it's all the things we talked about. Insurance is a problem, right? Insurance losses are a risk we already have. This would be better. Doesn't cost anything to get started, which means your down payments go up. It takes an hour less to get a person out of the door, which is, we probably have the longest sales process, as far as, the car buying experience, because of the length of underwriting and the questions and the, 50-page loan closing documents and everything else. So when you can make the staff buy in early as to how it helps the customer, how it helps them going to sell more cars, then, the sales process, then that's how you can get, you can kind of get that good penetration. And then those same rules apply, when you're talking about warranties and gaps, right? It's like, well, if you're not charging the customer for gap and they charge off, what do? You just charge it off. So you're giving them free gap and they don't appreciate it, right? So build it in, right? Even a couple extra dollars of interest income over a 1,000-note portfolio adds up. Right? This is real money. Yeah. And that's why these damage waivers and these debt cancellation, he said it perfectly. It's found money. And it kind of has like a zero impact on your business, right? You collect this much and it goes out. So it doesn't even really add to your profit, but it absolutely protects the bottom line.
It actually gives you extra cash flow. People forget about that when it comes to CPI. You get to hold that money as long as 45 days a lot of times. And we all know how much money costs, right? And so if you can hold an extra $20, $30, $50, $100,000 a month for 45 days, that goes to the bottom line. So you also got to think about that. When it comes to sales processes to get great penetration, it's process. And we have a process of a 6 square. And I know, the typical car dealer talks about a 4 square, right? But we went to a 6 square, and the reason we did that is that, and this goes for every deal we do, it's broken down into 6, and the bottom right is the lowest payment without anything, right? And the right side of the page goes up with gap only, and the left side of the page is. I'm sorry, I said that wrong. It's only warranty only, 2436. And then on the left side of the page, it's the top left box is all of our products. And that's the payment you're going to have with all of our products. And you'll be amazed how many people pick that highest box every time. And the reason is because they understand the value of this protection.
Right.
Because they understand they got to keep running to get to work.
Yeah.
And so it's presenting, it's 100% of the product, 100% of the time, and people forget that. That's what the process is. 100% of the product, 100% of the time.
Yeah, and you always pitch it. And you talk about, as long as you've been around, the debt cancellation and the days of selling cars as is. And when you start putting these things in place, and you probably experience the same thing, when you have a warranty program, it's almost like you might have more repairs, but they weren't the catastrophic ones. And I think the biggest thing that's overlooked in having a program like this, even if it's not reinsured, right? Just communicating is your customer's driving with insurance, they cancel it, perfect payer, they disappear. Where do you find the car?
In the tow
Impound.
yard. Yeah.
It's an impound, right? They didn't call you. Your customer has debt cancellation, CPI, or a damage waiver, and they get hit. They call you before the cop's there, wanting to know when you're getting them their new one, right? And so one of the things that I think is the most overlooked, even more important than all the financial, is if you have an insurance solution, a service solution, gap solution, you are creating multiple new points of contact with that customer. You are their landlord again, right? You are their source of contact. Check engine light comes on, now they're calling you, not ignoring it. Insurance issue, they call you. I wrecked my car, I call you. And that is something that, everybody struggles with is communication, right? I mean, who here has ever had a customer that was 6 weeks behind, you can't find them, but then their check engine light comes on, they call you for an appointment.
Immediately. That's
Right? Oh yeah, bring it on in. I'd love to see my car again. Thank you very much. Yeah.
I mean, how many times we
Yeah.
how many times we repossessed the car because they brought it in for service, right?
Bunch of times.
I mean, it happens a lot. They bring it into service, and then, oh yeah, we'll take care of it. Then the collector goes, hey, I see that car's in service. She's like, you need to just hold it there until I tell you to release it, right?
Well, and that also happens. You've also had that same guy come in for service, get an engine, and leave, and nobody told you he was there.
That happens too.
And he was 6 weeks behind. The
Yeah,
whole
that
time.
happens.
Yeah.
That's one thing that we haven't talked about is infrastructure needed for these things.
Yes.
It's one thing to have a reinsurance company and get this great penetration, and then you start having damage if you have CPI. Then you start having engine failures, and if you do not have the service infrastructure in place, this is hard. Mm-hmm. And I found that out quickly when it came to CPI. We have our own body shop, but unfortunately my dad's my body shop guy, and he's not very good. He's really good at painting classic cars, but for some reason he can't fix anything else, right? So
How long has he been with you?
yeah, he's when he's fixing his own, it's great. But if you do not have infrastructure in place, you can get in trouble real fast.
Yeah, and Brill, you talked about that, right?
Yeah.
With your volume and everything, having your structure in-house. So tell us about that.
Yeah, so of course, getting a buyer-payer business, the first principle I learned right away was, I'm not in the sales business, I'm in the collections business. Mm-hmm. You get into reinsurance and servicing, particularly in a less expensive, higher mileage vehicle, you got to have service infrastructure before you even sell a car. So, and that's how we approach it, and that's why we were able to not only manage it, but grow it. And that's why it ultimately became profitable. Because as you say, you're collecting lots of CPI premiums, there's lots of debt cancellation or service contract premiums. And, if your claims are through the roof, what good is it? There's still some benefit to it, but my point is to really manage it. And obviously it's a wealth creator if it's managed properly. And you're looking at that, it's part of your retirement package. But you never make that the priority that I gotta make sure I minimize claims so I can fatten my retirement. But it is that. So then that drives you to make sure you're doing the best practices on how you're planning for service structure and how you're sourcing parts, everything to minimize the claim to the satisfaction of the customer, of course. You lose that control when you're subbing everything out. Mm-hmm. So that's why it's really important, at least it has been for us, to bring it in-house. When we sell the car, whether it's the service contract or the warranty or the debt cancellation, our administrator can take all the calls, but we don't want them to do that. We take the calls because we want them to bring it to us. If we decide we want to sub it from there, that's fine, and we do, depending on the volume. But maintaining control, facing the reality of your market and your customer, and then planning ahead for that. Mm-hmm.
Yeah, as I'm saying, as I grow from a small, I'm going through that point of when does this become its own thing? Mm-hmm. Right now I've just got my receptionist that's like, hey, we just track this CPI thing, just enter in whatever forms they need, And eventually it gets to the point where this is a moneymaker, it is its own business and it needs to be treated that way. And so I'm kind of going through that growing pain right now. And maybe that's the question I'd ask for you is at what point do you have to treat this like its own standalone business, whether it's my CPI or my reinsurance? Where is that payoff of saying, hey, instead of us just kind of giving it half attention, we need someone to really focus on this and grow it and make it a profitable area.
Yeah, and it's a good question. And that'll lead us right into our last question here too, which is, and we make the joke, and I say this all the time. It's like, okay, I'm a car dealer, now what? You know what I mean? And I made it past my first couple of years, now what, right? And it's like, okay, I have a reinsurance company. I did all the things that my buddies are doing, like now what? And again, it's an organizational commitment thing. If you have service departments, then you're making sure that you're using them properly. And that means you're not only reconning the car properly, but then you're also making good decisions, as you service those cars. What you see with a lot of dealers when they first get in is reconditioning. The ability to recondition is so poor that, how dealers love to give every customer that 3-month or that 6-month third party, which is, I didn't have time to recon the car or nobody to do it for me, so I sold you the service contract. I hope that takes care of you, especially in the retail world. You see a lot of that where it's like, I don't have good reconditioning. So whether you have your own infrastructure and you're good at it, or you have sublet relationships, that are good relationships that, hey, these two guys do my recon, and, maybe if I introduce a warranty program or a service contract program, I'm going to make those guys my preferred guys and negotiate some type of internal labor rate and a moderate markup on parts. Because in a perfect world, your reinsurance company is all of these essentially third-party products that we've now brought in-house, right? So we used to outsource it, but now we own it. It doesn't make a whole lot of sense for us to milk ourselves, right? To pull money out of the reinsurance company back into our highly taxed entity. Because in most of those situations, GAAP, service contracts, CPI, who's the payee? We are, right? It's just our money coming back to us, right? And that's how you protect the portfolio, right? That's how you're managing the risk of, I'm buying these cars, I'm making loans to these people, and they're coming in. So it absolutely is important to have that infrastructure, but it also means that you might not be ready for everything.
Right.
That's the truth.
Maybe you're not in a position. I have people all the time, they're like, oh yeah, I want to talk to you about CPI, warranty, and GAAP. And I'm like, great. How long you been in business? 2 years. How many notes you got? 100. You know what I mean? It's like, okay, awesome. Like, what's it look like? How's this? Who does your recon? And it's like, you know what, CPI, yeah, that makes sense. But maybe we should find you a good third-party partner, and you should start selling third-party GAAP. And then once we've got a year's worth of data, like if that third-party company is getting smoked, well then you got to work on your business operations before you go owning all that risk.
Right.
And those are good decisions to have, good conversations to have before you get started.
For sure, and with GAAP is one of those things that can get you upside down real fast in your reinsurance company. We were upside down until COVID. And luckily with the high insurance payoffs during COVID, we finally got back right side up, because I mean it can be, if you don't have a good penetration rate in CPI or in GAAP, you can get upside down fast.
You can, and again, that's where training comes into place, not biting off more than you can chew, working with whoever your provider is to ask those questions, come train me, train my staff, make it make sense, do the math. Because, I mean, let's be honest. I mean, in this business, I know a bunch of very wealthy guys who can't read their own P&Ls. And then you introduce this to them and you just walk away from them. It's like, that probably wasn't a good idea, right? But in a perfect world, you've got a dealership, things are going good, everything makes sense. You're doing the CPI, the damage waiver, or the debt can. You've got a warranty or a service contract, and there's reasons, especially state-specific reasons, why you would want to do a warranty versus a service contract. A lot of dealers do both. They'll give a short-term warranty, they sell a service contract. Then they've got GAAP, right? You've got all the products, the VSIs, the PSIs, everything, right? Fast forward, you wake up, there's $2 million in your account. Now what, right? You've got reinsurance companies, all of yours have been going for a while, they're somewhat mature. You already alluded to it earlier, so we'll start with you. Forget about what the products did for your business. Now let's talk about what the profit that we pulled out of the business and put into the reinsurance company, what types of things have you been able to do with that?
Yeah,
that
I
also impacted your life
mentioned, I
and
mentioned
your
that
business?
before about,
Yeah.
first of all, the enormous tax benefits, and hopefully we keep them in the next election. But the enormous tax benefits, putting that money over there and that reinsurance and parking it there. And of course, every time the contract terms out, the money that you put in there, what remains is yours. So, our acquisitions and expanding service infrastructure when we were pushing volume, once again, we were always thinking ahead, thinking, well, if we're going to push volume, we need more service. So we'd go out and find additional service facilities that we can invest in. And so with that type of planning, you're already preparing yourself for the growth. And I just want to mention one thing you said earlier, Bret. I've been in 20 groups, right? I see guys in the 20 groups, and they're very proud of the fact they have very low recon charges on their cars, and they have reinsurance. And you say, well, if you have very low claims, that's probably a good model. But in other words, to be successful in reinsurance, particularly in warranty or service contracts, you got to put a good product out there to begin with, and make sure you make that type of investment so it doesn't break. But did I answer your question? I'm sorry.
Yeah, like you talked about real estate and.
Oh, yeah. Oh, that's what it was.
things,
Funny. Kevin Stoll's out there. I was talking to him, and we're talking about it. If I can just share quickly a personal story. Our daughter's getting married. She lives in London, and she met her fiance in Florence. They're going to go get married in Florence. So there's actually 3 weddings going on. We're going to have one ceremony at the church in London, and another one at the villa in Tuscany, and then one back here on the East Coast. So I said to Kevin, "Thank God for reinsurance."
Yes, agreed. We had 4 kids in college all at the same time, and it definitely came in handy. That's for sure. What about you? What's your goals? We were kind of having that conversation this morning too, like thinking long term. What can you do with it?
Buy a soda pop. I don't know. I'm gonna go out to eat this week. I don't know. Not in that ballpark. So, but seriously, I'm paying down higher interest debt.
Yep.
Borrowing it back to myself, and then I've got a small bank loan that's variable, and so obviously that's taken off and gotten ridiculous. So I'll pay that off. I've been very aggressive getting it paid off, and that's gonna save me, $10,000 a month in cash flow that I can now redirect it something else. So being able to just get it back into the business for me, where I'm still kind of in growth phase, I'm not fully in, protected phase. That's where I'm at.
My dad and I, we opened this reinsurance company in 2011, and I believe last I checked, we were about $4 million invested in the reinsurance company. And at typical tax rate, that's saved us, probably $1.5 million in taxes over those 15 years. That's a big number, right? And with the short-term capital gains, you're able to, if you do pull the money out, we pulled out $1 million in cash, I think, a couple years ago. He wanted to do something with his. I said, I had an opportunity to invest in a hedge fund, so I put $500,000 in a hedge fund, right? Just to see where that goes, because that's the opportunity it gives us. We've bought several pieces of real estate that doubled and tripled in value, and we've used our own money to do that and paid ourselves 5% interest to buy those things. We've invested in our company. I think he and I have put $750,000 in cash into our business to grow our portfolio. So, all these tax savings, and then we also, because we had another tax event during COVID that we had a big year, so we had to do VSI and we were able to run the money around and save a lot in taxes that year. It's just all these ways that you can use a reinsurance, and we say this on the podcast all the time. It's a wealth builder. You said that. That's how you build wealth, and building wealth includes buying real estate, investing in hedge funds, and also saving in taxes, and that's what we've used it for. And I don't know where we would be. We wouldn't be in the position we are today if we didn't have a reinsurance company. I just wish we would have started it, 5 years prior when I started thinking about it.
Yep, and as we're finishing up, one of the things that really jumps out to people is after you've been doing this for a while, especially if you've been in business for a while before you start a reinsurance company. And then all of a sudden it starts to grow and you start using it for other things and you kind of think to yourself, what did I do with that money before? Like, where did it all go? And the answer is, one, you dump it into things in your business. Again, reminding yourself that those were expenses you already had. You were spending the money before, right? It's not like all of a sudden you have $4 million in a reinsurance company, you used to have it in your bank account. It didn't exist, right? So by accounting for it that way, it forces you to look at all of those things. You actually get better data about your business because loss ratios matter. Absolutely. When people are connecting matter. And the best part about a reinsurance company, and I beat this horse to death, that it's not one size fit all, right? You got 3 guys up here who've all been doing this for a long time. They all do it completely different. So why would I want a 12-month warranty versus a 24? I don't know. What's your loss curve, right? How does a warranty or a service contract help you move your loss curve? And if we can move everybody's loss curve with the right program 3 months to the right, we'll do that math. How does that impact your business if every single one of your customers charged off 90 days later?
That's a win.
It's a win, right? So these companies are yours. You own them. People like myself, we just manage them for you, right? We're partners. But the idea is create these companies in your image with your plan, right? If you're getting ready to retire, that looks completely different from somebody who's in growth mode, right? Oh, I want to grow, I want to grow. I had a conversation with Steven this morning, like, how do I do that? Well, use that money as your own source of capital, because I promise you, you are the cheapest money on the planet. No offense there, Terry. Right? Like, your own money, loaning it from yourself is fantastic. Or if you have other businesses, or if you want to, like I said, deleveraging is very popular. Creating your own floor plan is very popular. I have people who act like it doesn't exist. They just don't touch it. They just invest it, and they don't ever want to put their hands in it. But all of those decisions are up to you, and what we're here for isn't to ever give you permission to access your money, but just for guidance, right? And I think that's how that relationship should go for sure. But I think that's about all of our time.